This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 2 of Value Investing. In the last episode, I discussed multiple items related to Warren Buffett's first investment partnership in terms of how he started his investment partnership. Second, how he structured his fees with his investors. And lastly, the strategies, like three main strategies that he used for his investment partnership. And I think that was a very interesting topic. And if you haven't listened to my first podcast, I highly recommend that you listen to that first and come here next. So I'm going to continue in this podcast. I'm going to continue to discuss about Warren Buffett's investment partnership. As I mentioned in the last episode, my objective of doing this podcast is to provide the maximum value to the listeners who are interested in value investing. And I thought that it would be very great value to the listeners if I talk about Warren Buffett. You might think otherwise because there are so many materials out there with respect to Warren Buffett, but the way I want to differentiate myself in my podcast is the fact that I go into the details and deep dive on the things that you haven't heard in other places. For example, I mentioned that I discussed about multiple items related to investment partnership he started in 1957, which not a lot of people just talk about in the normal setting. A lot of people talk about his recent investment, but they don't really go back to all the way back to 1957. So that's kind of the idea about how I started this podcast, and I hope that it's adding a lot of value. So in this episode, I'm going to talk about two things. First, I'm going to talk about his investment performance for his investment partnership over the course of 12 years, during which he ran his money for his investors. And second, I want to perform some deep dive analysis on some of the investments that he made during his partnership, especially at the beginning of his investment career. And there are two great examples, two companies that I can discuss in this episode. The first company is Common Trust Corp of Union City and New Jersey, and the second company is Sanborn Map. So I'm so excited about this episode as well. So let's get started. In terms of his investment performance, you can take a look at the letter that he published. Let me just take a look at the year 1968. That's the last year that he published the letter for his investors, where he showed all of his investment performance over the course of 12 years of managing money. So if you look at his performance, it's just mind-blowing. His performance has beaten the not S&P 500 back then. He only was able to measure against the Dow because S&P 500 didn't exist. But every single year, he had beaten the Dow by very large margin. So it's really hard to explain. Like, a lot of people in academia are trying to say that the market is efficient and there's no way that you can consistently beat the market. But Warren Buffett was an outlier, as you know. And it's quite fascinating to see someone like Warren Buffett, who were not born with a lot of money, and he didn't really inherit a lot of money from his parents. So he was kind of underdog from the beginning, but he was able to beat the Dow Jones Industrial Average every single year over the course of his investment partnership. So it's just quite astonishing. So let me just give you some stats. So if you look at the performance during this time period, his investment partnership performance, annual compounded rate was 31%. And if you look at limited partners' results after deducting the fees to Warren Buffett, it was 25% annual compounded rate. And what's the annual compounded rate for Dow Jones Industrial Average? 9.1%, significantly below. And let me give you a better picture, because if I give you cumulative result, then that's going to give you a better picture. During 12 years of his investment partnership operation, limited partners, the returns to limited partners, cumulative return to limited partners was 1,403%. If you look at Dow, only 185%. So he definitely deserved the fees that he collected from his limited partners. And you might think that, okay, it's possible that maybe back then the market was not that efficient compared to current market. And if you look at, he also, in the letter, he also showed a table listing the major mutual funds. So it was directly from Moody's Bank and Finance Manual, which publishes other mutual funds in performance. And during that time, they were more or less the same as the Dow performance. So which means it was back then also hard to beat the market. So that argument doesn't hold here. So I honestly think that this is truly outstanding performance for Warren Buffett. As you know, if you look at the current annual letter, he publishes his annual performance and compare that against S&P 500. But now Warren Buffett is tracking book value instead of actual investment performance, because his corporation does not have overall investment performance. So that was the one point that I wanted to bring out here in this podcast. And I thought that it's a very interesting discussion. So why don't we move on to the next topic? So in this letter segment, what I want to do is I want to do the deep dive analysis on certain investments that Warren Buffett made that accounted for a significant portion of his investment portfolio. What I want to know is the why Warren Buffett made the decisions to buy a significant portion of these companies at his early investment career. The first company is Common Trust. So this one was well-managed bank. And let me give you a little bit of stats of this company. Earning per share for this company was about $10, and the company was not paying any dividends. And the company was priced at around $50 when Warren Buffett was purchasing the stocks. If you look at earning that $10 and price $50, so which is approximately price per earning ratio is about 5. So if you're familiar with this PE ratio, price earning ratio, then you'll see that this is extremely undervalued company, because you're not going to find this kind of well-managed bank selling at 5 PE. So it was extremely cheap. So that really fits well with Warren Buffett's criteria, because at the early stage of his investment career, he was truly value investor. What I mean by that is he read a lot of materials and he was influenced a lot by Ben Graham. And his investment style was to buy at significantly below its intrinsic value. And later he transitioned his investment approach from buying significantly undervalued securities to buying securities with excellent business model at fair price. So that was a huge transition he made later in his life because of his business partner, Charlie Munger. But back then, he was interested in buying very, very severely undervalued securities. And this is one of them. In the letter, this one was the letter in that talks about 1958 performance. And in this letter, he estimated the value of this company at $125. So that actually represents PE ratio of 12.5. So you can see that I would say this is fair value. If you look at even in today's market, a lot of well-managed banks are selling at around P/E ratio of 10 to 12. So when he spotted this investment, he made significant portion investment in this company, and this company accounted for about 25% of his total asset. So that was a significant investment, and he didn't really diversify. In the last episode, I talked about this a bit, but he only owned 5 to 6 stocks at any given time. And that was his strategy. And he only made a large bet when he was for sure that this really makes sense. So through his investment, he was able to secure sufficient voting power. So this one was kind of controlled situation for his company. And he was expecting that at some point in time later in the future, the company might be merged with another company, which later happened. When I did more research, I found out that it was reportedly sold to a large bank at the time of the merger at around $250. So his investment gain, he was buying these shares at around $50 and selling at around $250, 5 times investment gain. That was a huge. So you can get a glimpse of how Warren Buffett invested back then, and it was very, very significant investment. And one other thing that I want to point out for this company is that the company was traded very thinly. Only 2 trades per month were executed with only 300 stockholders. This is very interesting perspective because a lot of hedge fund managers and also private equity companies do not want to trade or buy companies that do not have liquidity in the market, because liquidity matters quite a lot for large investment firms, and they don't want to touch the firms that are selling, at this significant below market level. But Warren Buffett was willing to put his money when the company was traded only twice a month on average. So that was the first company that I found very interesting in 1958 investment partnership letter. And why don't we switch gears to the second company and talk about that as well. So that second company was in 1960 investment partnership letter. And Warren Buffett talked about this company in details. So the reason is that this is one of the largest positions that he made for his investment asset, and it accounted for 35% of total asset. Can you imagine that? Because it's really hard to find hedge fund managers to invest this significant portion. And in some cases, people do, but this is a huge position that you have to justify to your investors if you make one. As in the case for the first company, Warren Buffett didn't really shy away from the opportunities and made significant investment here. So this company was engaged in the publication and continuous revision of extremely detailed maps of all cities in the US. You can think of this company as Google Map now, because Google Map dominates this place right now, and it can use this Google Map for various business purposes. It was the case for this company as well. The maps were sold to various companies, but mostly insurance companies. But other than insurance companies, public utilities, mortgage companies, and taxing authorities were all interested in knowing the details about the maps. And it was not easy to construct this map, so this one company had some monopolistic power. For 75 years, the company's profit had been immune to recessions, and the company didn't really require any capital expenditure that are usually necessary for a lot of business to maintain their business. And there was no sales efforts required. So there are a lot of advantages for this company. It's almost recession proof and no need for money for a sales effort, which means low operating expense, and no capital expenditure requirement, which is you get to have a lot of retained earning for whatever purposes that you want to use. However, when Warren Buffett was trying to buy this company, the company was suffering from competition after 75 years of monopolistic power. Warren Buffett didn't explain the details about the competition and what drove them, but after-tax profit in 1930s was about $500,000 per year, but it went down to $100,000 in 1950s when Warren Buffett were buying these shares. Then why the heck Warren Buffett purchased this company despite the profit deterioration? Remember, Warren Buffett at that time, again, was a value investor, only purchasing securities that significantly undervalued. What's quite unique about this company is the fact that the company had significant investment portfolio. When company was making a lot of money, I mentioned that the company didn't really require capital expenditure, which means company were able to retain significant of its earning and purchase a lot of stocks and bonds. So 50% of the company's investment was invested in bonds and the other 50% in stocks. So let me just give you some stats. The Dow 1938 was selling around in the range of $100 to $120. And the Dow went up to $550. The Sanborn Maps, this company, was selling around $110 in 1938, and it went down to $45 per share, 1958. And I mentioned about investment portfolio that this company has. So the company's investment portfolio during that time grew from $20 per share to $65 shares. So when Warren Buffett were buying aggressively in 1958, per share price for the company was $45, as I mentioned, and investment portfolio per share value was $65. So if you purchase at that time this company, then you're getting the operation for free because investment portfolio is $65, which is $20 above the current market value. So that's a classic example of how Warren Buffett identifies the great investment opportunities and purchases the shares. What is the catch here? And the reason why the share was selling significantly below its intrinsic value was because a lot of people were concerned that the cost of reproducing the detail maps, which was the main operating business for this company, would have cost tens of millions of dollars. That's why people were worried. And people were very fearful that companies gonna blow up all of its investment portfolios by trying to reproducing this detail map in order to maintain its business. So this is quite interesting play from Warren Buffett's part because I mentioned about 3 different investment strategies in the last episode. And one of the strategies is the called controlled situation, where Warren Buffett accumulates significant share of the company and later influence the management to change business strategies. So that's exactly the case in this investment. And Warren Buffett doesn't do that anymore, by the way. But back then, Warren Buffett was willing to accumulate a significant portion and try to shift the management's strategy. That's what Warren Buffett was trying to do. Warren Buffett was the largest shareholder for this company, and he teamed up with 2 other investment groups, which combined together represented about 44% of entire ownership. So they were able to pressure management to change their strategy and separate investment portfolio from its map business. That's kind of very similar to what a lot of private equity firms do nowadays. They try to get in and secure a significant portion of ownership, and they try to change management strategies. So it stood out to me that Warren Buffett had similar strategies back then. Now the $1,000,000 question that you may have is, can we find similar type of opportunities in today's investment environment? My answer is yes. So let me just give you one example. Macy's is one of the largest retailers in America, and it has suffered quite significantly in terms of its stock price because of Amazon. The current market value of Macy's is around $8 billion, and it has long-term debt of $6 billion. So if you combine them together, total enterprise value is about $14 billion. Then what about its real estate? The real estate that Macy's currently owns right now is estimated to be around $20 billion at a high-end estimate. So even if you take out $6 billion, then it's still equal to enterprise value of Macy's. So I think that if you have a lot of money, $20 billion or $14 billion, you can accumulate significant portion or buy Macy's outright and completely liquidate the business by closing out all the stores around the United States, and you still get significant value from its own real estate portfolio. So can we do that? Maybe not, but what I'm saying here is there are some stocks with this kind of attractive asset values, and if you get in the right time, and if you have the ability to influence management team, just like Warren Buffett did, you might be able to realize significant value for its shareholders. So those are the two companies that I discussed in this episode, and I think that there will be a lot more examples like this, and I'm so excited to go into actual case studies because it shows the rationale why Warren Buffett purchased such companies. And if you understand the rationale and the reasons why Warren Buffett made that significant position, then you'll be able to emulate Warren Buffett and follow his footsteps. So thank you very much, and see you next time.